Good evening, everyone. It has been quite some time. It took a little bit of hiatus, but here we are back again. It is Tuesday night, 9:15 p.m. Eastern Time, 6:15 Pacific Time, and it is October 1st. How you doing, Kris?
Good, man. Since China's ripping, I'm doing good.
China's China's definitely ripping. We're going to talk about a lot of stuff today. We're going to talk about the port workers on strike. We're going to talk about China making it rain on everyone. We're going to talk about World War III or possible World War III. And then we're going to talk about the Apple iPhone 16 falling short of expectation and demand. All right. So let's get started. How do you start the show and you're already yawning?
Bro, this is like my morning time, man. I just woke up. You know, I work at night, sleep during the day. So, yeah,
You're a vampire.
pretty much. Pretty much. I mean, for me, it's like nine something right now. So,
Yeah.
um, yeah, man. The market's definitely been interesting to say the least. But this is our job, right? We just navigate it based on the data that's available to us, and all the data right now is pointing towards a strong Chinese stock market. And I think a lot of people are thinking that this is going to be like a very short-lived moment, and then we're going to go back to being in a China going back down again. And I don't think so. There's a lot of different structural changes that are being made that are not necessarily the case
Yeah.
um, in the past. So, we'll talk about it today. So, yeah.
Okay, cool.
So, what
So
are some of the topics you want to go over today?
I mean,
Let's
well, we
go.
can go over first. The big news of the day started out this morning, which we thought was the big news of the day, and then it turned out to be not the biggest news of the day. The port workers are now on strike, and I actually got this video that I want to play, but just to kind of recap a little bit on the markets, let me open up Trading View over here, and I kind of want to go over a little bit of the market action today because I did find it pretty interesting what was happening. So if I go over here on SPY, and then I look at the action today. All right, so we started that day. Everything was looking pretty good. I think the JOLTS data actually came out pretty good for the economy, or maybe not as bad as a lot of people expected, which is of course the usual narrative. But then probably around 9:30, as soon as the market opened, yeah, it ripped up into the open, and then ripped up into the open, and then it just kind of dumped. And actually, this is not showing the extended hours. 1 second. Where's my extended hours? All right. Anyways, so one thing I did notice last night, if I do open up the futures for ES here, is that basically that the whole strike actually started, or it was basically agreed that if they didn't come up with some sort of agreement by midnight last night, I think it was Eastern time, then the strike would commence. And the market kind of knew it was going to happen because they did reject that. I think it was a 55% wage increase. And once that was rejected, the market kind of knew. It didn't really go down a little bit on that news, to be honest. And besides, let's just say that missile attacks didn't happen. The most anticipated missile attacks didn't happen. Do you think the market would have been up or flat today, pretty much doing exactly what it's been doing the last couple of weeks?
I don't know, man. Short term, these things are just volatile. All I could do is just track sentiment. Sentiment is overly optimistic, and
It is
so a
very
lot of
optimistic.
what we're seeing is just a retracing of that over optimism is just coming down. If you look at that CNN fear and greed index, it's peaked again, and so it's one of those times where when optimism becomes too much, you're always going to have these moments of mispricing on the stock market, and it ends up being that people are just overly bullish on things, and especially currently when you look at the S&P's like total return, I mean PE right now, it's sitting at all-time highs. So even on a forward basis, so right now, I mean, the short term, I can't tell you how to proceed on anything. All I can say is, look, the value is in other sectors of the market. How this strike is going to impact us is still going to be left to be seen. I think it's going to be based on the duration of that strike, right? So the longer it goes out, the more of the latent impacts that we're going to feel But from what I gathered and the data that I saw, a lot of companies have actually had a lot of their orders in beforehand. So they've already stocked up for Christmas in anticipation of something like this happening. So in terms of like total market impact to the consumer, I think it's going to be very mild in the short term. If this does get extended out, it's going to be a lot more impactful. The other thing is, Biden has basically said he's not going to, use the Taft-Hartley
Yeah.
Act and break the strike. So it just means that, you know what, the market right now is probably just at a standstill on what to do. And then you've got all these other risks that are coming around with Iran as well. So yeah, just overall, it's a very confusing market to be in. It's very volatile. I'd rather not be in US equities like unless like the valuations are absolutely torn down, in which case there's a lot more room to the upside and there's a huge amount of safety that's built in as well. So other
Yeah.
than that,
I don't necessarily think the entire market is overvalued. A lot of it is really concentrated in the S&P and especially the Nasdaq, and especially a lot of tech. The Russell historically does not trade at a higher PE, but it is trading historically below its average PE, which is pretty good. So I would say, as far as evaluation goes, not for every single Russell or small cap company, but the profitable ones, S&P 600, which is the small cap S&P index. I would say that is probably something that has a little bit more upside than, I would say, the IWM. But if it's risk on, then definitely the IWM or the degenerate stuff will definitely get bid up a lot more, while risk can still stay elevated. You're sharing something there. Let me throw that on here.
yeah,
Go ahead.
yeah. I mean, if you look at this is like the PE for the US stock market. Okay. So you can see here where we are in relation to, hold on, let me just go to the actual screen. You can see on a rolling basis how far we out. So on a 1 year basis, of course, that's not really helpful.
That's a cool chart. Why don't you zoom in there a little bit?
Right here. Hold on 1 second. So if you look at this on a rolling 5 year basis, we're kind of like overextended on a 5 year basis. Usually, when you're trending on a downward move, usually you're below, but then when you're on an upward move, you usually want to see a nice rise. And then any opportunities where you see this break from standard, you kind of want to say, okay, the market is kind of oversold and you want to kind of buy into it. So you can see the general trend that we have after the great financial crisis is a nice general trend upward in terms of total earnings. But at the same time, we might have gone a little bit over with that. So this is not to say that, we're like super likely to get like a huge downward move, but the likelihood is that earnings are going to have to like catch up to, or PEs are going to have to catch up to earnings, right? So as earnings grow, PEs will normally stabilize. So if you're buying around here, you're more than likely to, I don't want to say underperform, but the chances are that
If you're
be
buying
like,
US equities, or if you're
if you're
buying
buying,
companies
yeah,
in, what is this? Is this S&P 500? Because I don't
yeah,
see what.
yeah,
Okay.
no, this is just the US market, like total MSCI. So
Okay.
if
Okay.
you look at,
Oh, okay. Okay. Got it.
yeah, if you look at this on a total, like a 10-year rolling basis, you can see that we're even more inflated than historical averages on a 10-year basis. And on a 20-year basis, you can see the PEs, they
Well,
typically
you're
stick
also
around
including the
15.
lost decade there as well.
Yeah, yeah,
If you're
but
doing the 20 year, can you just do rolling 1 year?
yeah, rolling 1 year, you're still at a high point, you know? So
Okay.
you've got these price movements down, but I'd rather, for me, I'd say a sweet spot is about 5 to 10 years, usually a trend that the market tends to follow. And then based on that, I'll adjust myself and find companies that can basically keep this PE momentum for themselves up. And remember, this is all based on growth. So right now, the US is still a growing economy, still doing really well on a growing basis. So of course, this is going to move up and to the right. It's just that you typically want to avoid these long drawn out decades where you're going to see this giant move downward, right? And then that's when you get like a lost decade. So if you look at like a lot of tech companies, a lot of people that invested in the stock market in 2020, like in the 2000s, they did not recover until the late end of the 2010s,
2013.
right? Yeah, so you just have to be very careful which companies that you buy into and find, like I said, it's just this is just how it is. And then when you compare that against, like, let's say the Chinese market, because or the Indian market, I know a lot of people are very like bullish, like, oh my god, buy India, India, India. And I'm like, all right, well, let's kind of take a quick look at India.
I mean, that
And
rally has already happened.
look at this is the Indian stock market on a PE basis. Rolling 1 year, rolling 5 year, it's already accelerated way beyond that. Rolling 10 year, right here, it's trading at almost 27 PE in India. So yes, India's growth rate is pretty high right now, and they're doing really well. But in terms of like total market speculation, they're a bit on the high side. So this is not to say that there aren't individual opportunities, but in terms of like a total index return, you're buying pretty much at a high point. And then last but not least, when we compare it to the Chinese, which I think it's one last thing to just show, and then after that we can kind of go back. China. Okay, there we go. So if you look at China, on the other hand, right, on a 1 year basis, they're pretty much still flat or underneath almost. On a 5 year basis, they're below. With the recent rally, they've kind of caught up just a little bit higher. On a 10 year average basis, they're still at a discount. On a 20 year, they're still at a discount. So the Chinese are more than likely, because of all the stimulus, you're going to see this line hopefully trend a little bit higher, in which case you'll see like the stocks recover. So right now, most of the Chinese equities, they're trading at, like, they were last month trading at about 9.34%. Now they're about 11.83. I think a 15 PE with all the stimulus measures is probably fair market, and like 20 is a little bit overvalued because of all the demographic headwinds that they have. So
Yeah,
I'd say,
I wouldn't
I'd say,
expect that to get to like US
yeah,
type of PEs, only because of the fact that there's a lot of risk. I mean, the market does know, or a lot of investors are aware of that risk, or traders are aware of
yeah.
that risk. But one thing that I've been actually, we'll get back to the Chinese markets. Just wanted to close out the port stuff, because I did want to just run through an article real quick.
Yeah.
I mean, it's already the end of the day, so a lot of you guys have probably already heard about it. But one thing to note here is that every single week here, let me just zoom in a little bit. Every single week that this strike lasts for, it's about $4.3 billion lost in import and exports, or basically the GDP. You see, now when I think about something like this, I'm not necessarily thinking that, oh, well, every single week we're going to lose 4.3 billion, and this lasts for like 3 weeks, we're going to lose like 12 billion off GDP. And GDP is it's like 200 billion. I forget exactly what number GDP is, and every percentage point will matter. But I mean, we had the auto strike like a year ago, right? And
Mhm.
that was kind of a little bit of a scare too. Maybe not to the specific, maybe not to this degree. But at the same time, it's like these things tend to resolve itself. This kind of fear in the market does come and go. I again, and I know I reiterate this all the time, is that the economic data does look very good right now. It doesn't look at anything is deteriorating, and I would say like any interpretation of the economic data to say that it's going to curl over is really based upon patterns and trends that could possibly persist. But we are generally still in uptrend, and for me to actually get out of the market and more into safety assets, I would really have to see some sort of technical breakdown in the market, in addition to some economic indicators that might be there. Now, a lot of people are probably saying like, oh, well, hey, I mean, by the time you see it happening, the market's already going to be down. Well, that may be true, but if I'm sure, it depends on whether you're in for the long haul, whether you're trying to time the market, whether you're trying to get out and get in, sort of thing. But if you have like more of a long-term mindset, then you can take a little bit of risk. You can take a little bit of a drawdown. But as far as I see, there really are no flashing signs. Like if I take a look at, let's see here. If I go back to the fear and greed index, all right. So today we closed at 69. Yesterday was 75. So we did have a material pullback in terms of this index that they have here. But if you look all the way from, let's say, beginning of December, we pretty much stayed in bullish or an extreme greed or higher all the way up until April when we finally did have a little bit of weakness in the market. And if you remember from this point, the market didn't really have I wouldn't say it went in a straight line up, but this was like the period where the market literally did not have more than a 2% drawdown. Now, I'm not saying that this is going to happen. What I'm saying is that I have not seen that technical breakdown yet. We're like less than 2% away from all-time highs. We did have a little bit of a pullback today, which was probably the VIX went over 20 today. And I was actually thinking it might close over 20 today, which if it did, then that might kind of be a technical sign that there might be risk taken off the market. But I wouldn't say that this dip was bought up pretty hard. And again, I wouldn't, if you ask me, like I did buy some of the dip today, but it was not in US equities. It was in non-correlated assets. But we could probably talk a little bit more on that when we get to the next topic, which would be China. So we went a little bit into this, or you went a little bit into this. Did you want to expand on this thesis more, or you want me to get in?
There's a really good video that I think we just watch it really quickly.
David Teppa.
No.
Okay.
Expert on Middle East affairs. You are certainly not unfamiliar to how geopolitics affects the investor psyche and affects investment planning. When you have something like this that for a lot of people was a surprise, what is sort of the first thing that you look to in terms of telling your clients, your colleagues, your peers to do next?
Well, the important thing is to separate the noise from signals. And I think unfortunately, or perhaps fortunately, and I don't mean to sound dismissive, the markets have been conditioned in the last few years to react temporarily to these issues. They will bid up safe haven prices, gold, oil, treasury prices. But then as soon as they get the all clear signal that things are under control, they'll put it behind them and go back to whatever they were doing. So long we don't get further escalation in the coming days, I think the market will look past it. Now, one of these days, it will be proven wrong, because I do agree something has to get worked out in the long run, and the conflict seems to just be escalating.
Wait, can you just put it on pause for a second?
Cumulative effect.
Yeah, this was not the part. I was actually waiting for the China part, but he just kind of spoke about this first. There was a quick, there was a mention about about like the Chinese markets. Let me see.
Possible that those tailwinds could outweigh any potential negatives we get from the election itself.
Right. Activities, would that then disrupt the rate?
As well as an economic impact.
Overseas.
All right, you know what? I can't find the clip. It's fine. Like we can watch the other one from Tepper.
What was the gist of the part that you were talking about?
No, that China's got a lot more room to go up, basically. That's the general consensus that I'm coming to, where right now the entire market is very underexposed to China. I mean, all the data that, like I said, the data points that I'm seeing are very clear. And like if you look at this right here, this is the all world China, not just China, but all world exposure to China right here. And you can see here the world has been least exposed to China in literally in decades, even though they're technically the second largest economy on the planet. So the thing is, a lot of funds right now, even though they'll come on CNBC and they'll say, "Oh no, this is just a temporary thing," the background is everyone is buying China. Like
I hope they continue saying that.
Yeah,
like I really hope people don't flip.
All these people are basically just kind of just BSing, and I don't think that's the case at all. I mean, literally every one of them is buying hand over fist Chinese equities. I mean, look at the markets. They're rising. This is not just like some retail led bullshit where people are just buying a few shares.
It can't move like that. If it's not retail led, it can't move like that. Check this out. The percentage of short interest. So this is for FXI. Basically it's the China fund traded in ETF traded in the US, large cap China stocks. And it's 60% short. Now, I don't know. I have to be honest. I don't have Bloomberg terminal, so I don't know how accurate this is. There might be
accurate.
like it, but like it could just be like hedge. Like, so there might be hedge funds that are, or there might be large institutions that are actually long China in different derivatives or different instruments. or even like single name companies, and they're just shorting the entire ETF to mitigate that risk, which can happen, you know, for long short firms. But if we scroll down here, this doesn't really give like a whole thing here, but if we look at just how much a short interest was coming into this year, as well as late last year, like it has always, the short interest has always been high in China. And this is actually as it's coming down in price. So
because it's easy to make money shorting China.
yeah,
like
it's basically been like the yen trade or the yen carry trade. It's just, yeah, go ahead.
The key thing was with China is their property sector. So everyone saw the implosion in their property sector, and that was going to eventually translate into its economy. Like that wasn't a secret by any means. So if you look at this, you can see here when you compare it to like the United States, right? The US real residential property prices post great financial crisis, they started to rise significantly, right? Whereas the Chinese, they started to rise, but then after 2021, after COVID, they started to fall off a cliff. And then you had Evergrande and all these Chinese property developers.
Thing, dude.
Yeah. And so they literally, China had this 2008 kind of moment. And the thing is, everyone was dumping this stuff. And so, you know, that's why you got such great deals. When everyone is fearful, you need to be willing to go in. And what's funny is when I go on Twitter, or if I'm doing like something with Ahmed or something, not that people don't believe it, but they've become so fanatical with being anti-China. They're like, oh, you're a communist. Like, no, they're communists in name, but they're pretty capitalist when it comes to their, you know, defining how to do things. So as far as like, yeah,
if you want to make money, like you need to put your personal views, your political views, your beliefs and your morals and stuff. If you want to make money in the stock market, you just need to put that shit on the side. You know, I feel like a lot of people put too much of their moral belief. I mean, I would personally say that because like you're here to make money. You're not here to chat, kind of like prove a point, because guess what? The person who's selling their shares to you when you're buying them, the person who's buying the shares to you and you sell it, they don't give a shit how you feel about humanity, how you feel about politics, and whatever. There is a certain sense of morality that you could put in it, but that's only if it develops an edge. I mean, I just feel like, you know, every single election we go through like this little turmoil. We go through like these little volatility stages, but at the end of the day, once you find out who the president is, the market just basically goes up from there because the uncertainty is priced out of the market.
I think there's levels of acceptability when it comes to kind of like that kind of thinking. So like, here's the thing, like, would you want to invest in Mercedes during, you know, the Holocaust? Probably not. Like, even if Mercedes is making a ton of money selling tanks to the Nazis, you don't want to be involved in that because eventually you know that it will fall on itself, right? So
to be honest, I don't think the market wants to invest in Mercedes at that time too. So I would not want to invest in Mercedes. Like when I say throw out your morals out the window, I don't mean like who gives a shit, you know, just buy like Philip Morris or something like that. But if Philip Morris isn't performing, like why would I buy them? Like I would have no reason to buy them, you know? Like it's like, would I buy China stocks a year ago? No, I wouldn't, because it still is pretty bad. But what we've seen as far as the liquidity injection that is getting commanded by the PBOC and Xi Jinping is that, like, dude, they're going to do whatever they can at this point. Like, it's done.
Yeah. So just backtracking one thing. So the thing is, for me, when I look at these things, I think of it as risk, right? There are certain morality levels of risk that you have to build into your thinking, right? So as an example, would you want to invest in China if it was trading at a 22 PE, you know, with all the morality issues in the background? Probably not, because, you know, there are people who are basically going to be like anti-China because of that. Now, what does that mean to me? That means that, hey, you know what? Maybe I need to ding them a couple of points on the morality scale, on the total valuation. So I think what it is if you're too hardcore into valuations just based on total value, you can lose the multiple issue, right? So as an example, like cigarettes, right? Like let's just go example cigarettes. Cigarettes, they're really bad for your health. Now the thing is, there is a valuation at which Philip Morris and British American Tobacco are actually very good to buy at, right? But then there's also other multiples that they're not good to buy at, regardless of how great the business is, mainly because there is a morality like portion in that valuation matrix that you have to account for, because what you're essentially doing is you're also limiting the amount of funds that are going to be able to put money into the investment. So, you know, I'm not saying like I'm an ESG champion and everything that we have to do is based on that bullshit, but I'm also not saying that, you know, we can't take that into consideration as a risk point. So I would say China at 22 PE, probably not attractive. 8 PE, very attractive. 15 PE, attractive. Like, but fair value attractive, you know.
Somebody's saying Bob is ripping right now.
Yeah, bro, Chinese equities are going to keep ripping. It's just there's so much pent up demand for there's so much pent up demand for them right now. Like you've got, I think also the government itself is kind of shifting its model from property driven like, you know, wealth creation to more equity based wealth creation.
Yeah,
because equity based consumption is a lot more liquid, and so even when it comes to injection of, you know, basically like confidence, it's much easier to inject confidence in the markets when you are basically manipulating the stock market a little bit, right? So like right now here in the US, you know, one of the things that, I mean, and this is just my anecdote, so don't think like, oh, this is like a proven thing, but in the US, we have so much more exposure, our population, to the stock market through our, not even just direct ownership of stocks and bonds and all the other stuff, but also because of our pension funds, all this additional stuff is all in the market. So what happens is people's sense of wealth comes from their portfolios. So, you know, when things go down, people have that reverse wealth effect, in which case people cut back on spending. But it also means that when you inflate the stock market, you're also going to have a lot more people spending more money, right? So right now, a lot of people, they're happy, they're jovial, they're spending their money based on what they're seeing on their portfolios. They're like, oh, my portfolio's up 20% this year. Bro, this is great. I love this. I'm going to go out there and buy that extra car that I didn't want to. The Chinese don't have that option, because majority of the Chinese wealth is derived from their property sector. And so because of that, the property is a much more illiquid asset. So the value of your property, if it drops, that reverse wealth effect is going to end up, you know, becoming more like based into your psyche. And the thing is, unless those property values go up higher, you're going to keep feeling poor, you know, because the stock market is not there. So now what you're seeing is the government kind of like prop up the stock market, but then also a lot of new speculators are jumping into this market. And I think, I don't want to say that we'll get back to a 22 PE on the Chinese stock market, but I don't know, man. I mean, this is going to sound a little bit racist, but Chinese have been very, very, like the level of speculation that comes out of China is really, really high. Like if you've ever been, they're way degenerate. They're just degenerate gamblers.
Macau, baby.
So, you know, I mean, it's just, I don't want to say it's like naturally in them, because of course, you know, that's a epithet. That's not true. There's tons of people that are in China that are a lot more, you know, like reasoned investors. But the thing is, there's a level of speculation that happens within that culture that's acceptable, and so people will do it. So a lot of people speculated in the property sector. A lot of people will go gambling. A lot of people will, now that they see the stock market ripping, a lot of people are going to jump into the stock market and they'll chase it. And the thing is, like, we have to be smart enough to be one step ahead and realize, hey, this is where the chasing happens, and before the end, we have to get out. You know,
I mean,
so
you don't even have to be
like,
you don't have to be a step ahead per se, because like it's out there. Like the thing is up more than 16% in the last 2 weeks, right? And it's just like all over, you know, CNBC, it's all over the news and everything, that it's ripping so much, and it's no secret what the PBOC and the government's doing to stimulate the economy. The thing is that people have gotten so accustomed to the drawdown of the Chinese markets lately, namely since 2021, because it's just been pretty much down the whole time and all the rips have been sold, that people have the recency bias to believe that that's going to happen again. If you look at the charts, dude, it just goes up and then just comes down like the HSI. That happens all the time. So people have a tendency to have the recency bias to think that that is going to happen again. And that is keeping people away from buying the stock. Like there's even someone asked in the chat, like, is it too late? Yeah, dude, it's just freaking ripping. It's crazy.
Look at
Even
this. I'm looking at
someone-
Baba right
yeah.
now. It's up another $2 overnight, bro.
Yeah, I know. I got the HSI futures open. It just like jumped up 50 basis points while I was yapping. Now someone asked about what about the IV on the leap? So yeah, me and you, like we're in leaps in China, and I'm in KWEB, and what are you in again?
FXI.
Yeah, you got leaps in FXI, and like I'm not playing no short-term game with this, right? This is going to be a very volatile market, and you will probably not pick the bottom. Like you can't just get in now and expect to just go straight up. Like let's be completely honest, right? It is going to be extremely volatile. There's a lot of money. They halted the Chinese stock market last week because of how much it was ripping up. And then there's certain brokerages in China that are offering 24/7 trading services to accommodate the amount of liquidity that's being pumped into the markets during the trading day. Like they want to disperse all that liquidity out throughout the time period. So that way they're not just bidding up the market as much straight up. Because I mean, let's be honest, like when you price in a lot of this stuff, the fear is that it's going to come down pretty hard when people get scared. I mean, dude, like literally just in the last 2 minutes, HSI futures have went up 1%. I don't know how much money this thing pays out per dollar. I mean, per point, but I'm sure it's a lot. And the thing literally just jumped up like 200 in the 2 minutes I was talking. Like this is a crazy move for a huge, massively trade on a global scale futures market. So like
this is just the damn beginning. That's the part.
This is just the beginning. It's just like I don't want to go like this is not financial advice, guys. Like we are not telling you to buy anything. We're just telling you what we're doing, and you can do whatever the hell you want to do with your money. And I would ask yourself, how much risk are you willing to take in, and what is your time horizon? If you're retiring tomorrow, all right, and your risk aversion is low, right, then don't buy this. That's like asking, like, should I go buy Amazon, right? Like if you're going to retire tomorrow, like you should not be buying US equities. You should just be buying treasuries. And when I say treasuries, I don't mean like go out there and buy TLT. I mean like literally buy treasuries from the US government, right? So you can be guaranteed income from the government, right? That pretty much like it's risk-free debt. It is literally called risk-free because there's pretty much zero risk. And if there is risk, if you don't get paid out, you do not have to worry about your money. You don't. You have to worry about not getting shot in the street or something.
Yeah,
but yeah, man.
There's one problem with that. Inflation is going to eat away. Unless you're getting, unless you're making more than inflation, you're basically, getting screwed over. If anything,
well, right now you can. You can right now.
If you have like a 6.5-7% mortgage, that's the thing you should tackle if you just want a guaranteed return. Just knock out all your high interest debt, But overall, this is the one thing I just want to highlight. If you look at like the overall market, like you see this right here, country wise. God damn it, this thing went away. Like country wise right here, I can't blow it up. But just from a PE standpoint, India's at 27, the US is at 25, Canada's at 18, Japan's at 17, China's only at 11. Second largest economy on the planet, and they're at 11. So this is eventually going to make its way up here somewhere. So just from where we are today, we're looking at least. No, it's not going to happen tomorrow. But we're
at this rate, it's going to happen tomorrow. But yeah, no, I hear you.
I think it's going to be at least a 50% rise in the next year and a half, 2 years. So it could get there sooner. But here's the thing: we just have to be intellectually honest with ourselves when things do get overbought, and then you kind of see that there is a fundamental change in some of the stuff that's going on to get out, right? So I think that's the part that the value that I think me and you do when it comes to the Patreon is not so much what to buy. It's like, hey, what to kind of look for to get out, And right now the trade in China, even though it seems like it's parabolic and that it's overbought, and I'm sure that there's going to be periods of consolidation where things come down, you have to look at this on like a global macro scale, and the global macro scale is telling me that, hey, the valuations have still a long way to go. And with all the stimulus that's coming in to the Chinese markets via government, government spending and consumer cuts, consumer stimulus, you're going to see these companies' earnings jump also. So it's not only that you're going to see these companies with low PEs, but dude, their growth rates are going to accelerate. So if you look at Alibaba and everything else, their growth rates have significantly gone down. So if
Yeah.
you boost up consumer
Easy comps,
demand,
dude.
yeah, it's easy
Easy comps.
comps. And then at the same time, you've got, more stimulus at the consumer level. The consumer starts spending money. What are you going to have? You're going to have giant growth numbers on Alibaba and all these other guys, in which case this index is going to jump up. Now, here's the thing. And the reason why I bought the index rather than trying to pick individual names. This is still a communist country. Okay. There's still a level of risk that you take on by individual investing in individual companies and individual sectors, primarily because you don't know how the government is going to react to certain external stimuli that may come in, or even internal politics that may come into picture. So as an example, you had that Jack Ma thing happen, right? Like, who could have seen that coming? Where that one point Ant Financial was going public, and at the same time, so Jack Ma felt like he was on top of the world, and he started to say some shit, and that really
Weird.
irked the wrong thing. So the thing is, you could be right on your thesis that, hey, China is undervalued, and you pick a Chinese company, and then the fucking CEO comes out and is like a dumbass and says something. Now all of a sudden the government regulator comes and says, you know what? Maybe it's time to put you back in place. So when it comes down to it, that's the part that scares me a little. Yeah.
When it comes to even companies that have a large amount of revenue that comes from China, you can even think of a few off the top of your head. Apple, Tesla. It's mostly consumer centric or consumer discretionary stuff that does have a lot in China. So when I see something like Apple pulling back like this, people are assuming that iPhone revenue is going to be crappy. I mean, we'll go a little more into this later, but when you think about that, if they're developing some growth from China, then that's going to help their top line. I don't know about their bottom line, but it's definitely going to help their top line. It might promote growth. So this type of economic activity in China, for me, this is more of a global macro trade than anything. Not so much of I want to go long these companies. I would not, for me, it's hard for me to invest in individual Chinese companies only because I don't know, the economics and the policies and everything. It's just too complicated for me to understand, but I can understand more on a macro scale, what is happening in China. I would say this is very close to the equivalent of what we did during COVID, where we just gave out checks. We gave corporations a lot of money. We basically propped up the entire stock market. This is something equivalent to that sense. Not saying the bottom is in, because this thing could just go all the way back, but it's very likely the bottom is in for this. Now, the thing is are we going to see downside from here? And yeah, we might. I mean, the thing, if I bring up the IV chart over here, so this is basically the 30-day implied volatility for options on the index FSI, FXI. And we could see here that it's drawn all the way down to about 20%. And just since September 20th, it's already at 37%. That's a material move. Usually you see a big jump in volatility like this when the price comes down. But if the price goes up very quickly, you can still see the volatility spike. So if you think about it from a certain scale of options, you are paying more than what you would have paid for options if price did stay stagnant just 2 weeks ago. So you're putting a lot more money up front because of the implied volatility of the move. So the market is pricing in a much larger move in a very short term within 30 days for these options. So you're paying a lot of money up front. So if you buy an option today that expires next month or within the next 30 days, that thing better move big, because if it doesn't, you're going to lose your money, even if it goes up a little bit, and even if you're right and goes toward your direction. So, I'll just say these are things you kind of need to think about when you're getting into something like this. And it's super risky, man. It's super risky. This is not a safe asset by any means. But if I weigh the risk of putting money in the Chinese stock market right now versus particular U.S. equities that are very overvalued, I might choose to allocate some risk into that bucket. I'm not saying go full port it, but I'm just saying that there is value there versus over here. And I don't know, when I bought the dip today, I was not buying. I bought a little bit of US equities because come on, why can't I buy Amazon? Seriously. But I mean, it was much better value, even if after it had a big run in China.
The one thing that I'd say be careful with, and this is something that I started to notice on CNBC and everything else. So I saw someone come on that was bullish China, but the way that they want exposure to China is by buying US based companies that sell into China. So they're like, oh, well, look, if the Chinese are, like trying to increase domestic consumption, that means that this is really good for, this American brand. And I'm like, yeah, that might have been the case about 10 years ago, but I think Chinese tastes are actually been evolving, right? Where you're
Right.
actually seeing a lot more local products. Like, so here's an example. A lot of people are saying, and this might lead into our next topic anyway, regarding iPhone, right? Like, oh, everyone in China is like right now with all the stimulus, that means that China's numbers for iPhones is going to go crazy and it's going to, no, I think the Chinese have actually been kind of like using other phones outside of the iPhone market. So let me just look at the market share. China market share for cell phones. I think domestic companies are the ones that are going to be the strategic benefits. No, not yet. I'm just looking. Okay. Hold on one second. Phone. So, sorry. I saw this chart where basically domestic brands have actually been outpacing some of the more like American brands that are out there. So, when it comes to this whole thing that's happening with deglobalization, people are recognizing that. And a lot of people there's a lot of great Chinese companies out there and make good products, like regardless of how we may interpret it as, oh, China just makes they're like a third world factory floor that just produces our goods and sells them cheap. Like, no, they've got a domestic manufacturing base that's doing well on their own. And that's the thing, like a lot of the government programs and a lot of the consumer programs are going to be geared towards buying specific items that are more beneficial to the local industries rather than the US. So as an example, like you looked at the NVDA thing, where basically the Chinese government said, look, don't buy as many NVIDIA chips, buy chips that we're making, so that's a very interesting thing that came out. And I think that message is going to reverberate to a lot of Chinese consumers, where basically they're less likely to spend more on, I'm sure that eventually they'll get something out of it. But this whole thing with, if I want to be long China, I'm going to be long the companies that are in China that have like a source of revenue in China. Like, no, those just buy China, just stick to China, buy the companies.
Yeah, I'm not trying to figure all that stuff out. Let me get like a secondary, like my thesis on buying or owning a trade on Apple is not based upon the Chinese revenue is going to come back. Like, it's more of a sentiment driven play, but like, I'm not going to buy like a certain stock because of the thesis that it's going to benefit from the Chinese. Like, I could have kept Micron, but because 30% of the revenue is from China and they're probably going to see growth there. But at the same time, it's like there's also SK Hynix and Samsung, and those have a lot more presence in China than Micron does. Even though they do have presence in there, like that's not a thesis that I'll build that on. But then again, like you were saying with NVIDIA, I guess because Huawei is building their chips, they want them to buy it locally and domestically.
I'll give you an example. Like this
morning, up more than 8% after the big gains we saw last week. You were adding to some of your positions that have exposure to China last week. Which ones are those, and what do you think of what we're seeing this morning?
Yeah, I mean, the China stimulus is the most since COVID, so it's big. There's more they can do. They sound like they want to do more. We got a little bit of different news over the weekend as well, additional stimulus. The issue here in my mind is that this is such an under-owned space, Becky. The outflows in 2023 alone were $30 billion. The stocks trade on average at 10 times forward estimates. And the emerging markets, the weightings from portfolio managers has gone from 35% to 21%. So
up to here, she's absolutely correct. Like she's making a good point, right? But here is where she goes into like the stupidity, and she's going to underperform now. Watch this.
There's a lot.
She's a value investor. She's a value investor.
And by the way,
but what?
I would say that if money comes out of India, because India has been the beneficiary of the problems in China, if money comes out of India, I would be buying India as a long-term buy. But China, I think, is a short-term to medium-term trade. And the names that I have been buying, Freeport McMoran, I have owned that in the past.
It's like, what? you she wants to
Well,
buy Freeport McMoran. Like, I get it. Like, look, if Chinese economy grows, you know, Freeport McMoran provides like steel and
copper,
aluminum
yeah,
and
copper, steel,
copper,
and all that,
right? So all of those things, like, yes, but those are not the direct beneficiaries. You know what I mean? For
Well,
consumption, you
you
know?
got to remember though that she is a fund manager, so she
Yeah.
has a lot of restrictions to what she can buy. Especially like she probably can't like open up a Chinese brokerage account and start buying stuff over there. It's like she has to obviously invest in like ADRs or something. But even so, like she probably has like some policies that she can't buy like Alibaba or something, or she can't
Let's look
buy
at
a Pinduoduo or Tencent.
let's look at the other ones that she called out. Hold on.
I thought
Dude,
that,
she's a
that's like
value
the
investor,
poster
man.
child for China.
Hold on. I'm telling you, let's look at some of her other picks.
Yeah, go.
Las Vegas Sands, which is still down 2% on the year, and ExxonMobil.
Wow. ExxonMobil, explain China exposure there.
Well, I just
even Becky Quick's like, wait a second, what?
I don't know why these fund managers do that. It's like they go for like everything but what will give them any alpha. And I get it, like they can't do that, but like in her terms though, in her defense, so she is a value investor, and I've watched her more than a few times CNBC, is that like even in this whole rally, she says like, oh, I've been buying this whole rally, but it's like, you know what she's been buying? She's been buying value stocks the whole time. So she's trying to catch up on performance. That's what a lot of these people aren't like. It's so funny because if you ask these people like 2 weeks ago what they would think about China, well, they would say the same thing I'm saying, that like I wouldn't buy it, but I will flip. But I do have the benefit of doing that because I'm a retail investor. So I can do whatever the F I want. But like when you're managing all that money, then you have like clients who like might be opposed to whatever. It's like she's got to walk on eggshells, dude. That's just how she is. But at the same time, it's like she's saying it's trade. Again, but it goes from saying that like, oh, I would never buy Chinese equities, and now it's like it's just a trade, it's just short term, right? And then later on, it's gonna be like, well, this is a good place to stay, you know, like it's gonna follow that Wall Street chasing. It's gonna follow the Wall Street chasing. That is gonna propel it to keep going up, man.
I mean, she's got like that traditional portfolio. I mean, I don't want to disagree with it. I think it's a great portfolio. It's just this is not the what's the word? This is not
is that her fund? Oh, yeah,
this is Hightower Advisors LLC. This is the fund that she has. So she's basically got Apple and Microsoft as leading amounts, right? And then she's got VTI, which is the index.
Wait, can you zoom in a little bit?
Yeah. Right here. You've got Apple, Microsoft, you know, IVV, Berkshire, Amazon. I mean,
do performance history. Performance history.
Let's see.
Does that perform in the market?
Okay. So it's 3-year cumulative return. She's got 37% cumulative. Yeah. So what is it benchmark against the S&P? So she's basically outperformed the S&P by about 10%. I mean, this is not hedge fund level returns, dude.
Hold on a second. Cumulative return?
Yeah.
3 years. Okay. I guess that's like a bad metric because that's 3 years ago, right? But is there a way to see the CAGR?
I don't know. But I mean, if you look at it on a relative basis, I mean, she's got good Sharpe ratio. She's
definitely a smart person. Don't get me wrong. Like, I'm not trying to demean her intelligence or her skill.
The point is, she is not a hedge fund manager. Like this is like an index manager parading around as a hedge fund, basically. You know?
Oh, she's an advisor. She's not.
Yeah. I mean, look, she can perform the market over a little bit. I mean, that's the goal, right? If you want to like get wealthy clients, you can't be all like crazy risk taking fucking let's go buy China. I mean, David Tepper can though. David Tepper's got money. You know, he's a billionaire. He's called it right. So
does he run a fund or does he run a family office?
He runs a fund.
Is it a fund?
Appaloosa.
Yeah. But I mean, that dude, he earned it, right? Like, no one's gonna fucking question him. Like people will be like, "You sure you want to do that, David? You sure you want to do that?" It's like people will be like, "Sure, go ahead, do it."
This guy's returned 25. This guy has returned. Look at this, 20, like over the course of 30 years, 28%, which is
an insane
nuts.
CAGR. It's crazy.
Yeah. So, yeah.
Should we do the David Tepper now? We only got
his 1 year performance is 45%. 3 year performance is 70%. 5 years 185%. And 10-year performance is 205%. So
That's crazy performance, man. Like, bravo.
tough.
And don't get me wrong, man. Like the people that come on CNBC, like some of them, like they know their shit, but like they have so many like stipulations and policies and compliance and all that stuff. Like they can't. And like if they're running like $1 billion fund or something, like they can't just buy stuff, right? Like they have to buy like highly liquid shit. So they're mostly in large caps if they're doing any options whatsoever, or they're mostly in indices. Like Stanley Druckenmiller, like he can't go out there and buy like options on Wolf. He has to buy the shares. He can't do the options, you know. But at the same time, it was like point.
I mean, I can't buy options on Savvy, but I'm kicking everyone's ass on Savvy. What does that tell you?
Yeah, dude. Honestly, I don't want to get into it. I don't want to get into it because we're in that competition going on right now.
Dominated right
I'm
now.
dominating it. What the, dude? Agent size up 3% right now. What the hell? Like, this is
I'm
crazy.
telling you, this is great for us.
Crazy.
I'll take it. You know how many contracts I have, baby. So I'm good.
Dude, I got a lot. I got a lot of contracts, and they don't expire for a year, so I'm good to just let a lot of it just ride, man. Like I am totally good.
Enjoy the ride. Enjoy.
Yeah,
the ride.
dude. And honestly, like, did you buy anything today, or you're just doing the?
Nope. I slept. I slept like a baby, dude.
Yeah, well, I don't know how it's like when I spoke to you, it was like you woke up in like the afternoon when the market already been. I'm like, a day like today, like I wouldn't want to be sleeping this whole day. I mean, but if you're in China mostly, then like by all means, take a nice nap, get some Starbucks or get some Luckin coffee.
I mean,
you know, just chill.
The thing is, what is it? I have the armor of being right. Let's just say that, you know, when you have the only times where I lose sleep is when I know that I'm taking a lot of risk. The thing with China is I know my risk tolerance. And I know I'm not taking risk because all the signs and the data is pointing to the right direction. Now, if you're now the other day, right before Carnival earnings, I didn't get that much sleep. Like I was awake the entire night. I was like, oh God, what the fuck?
I slept like a baby that night. I didn't even like wake up to look at the earnings. I looked the next day. I'm just like,
yeah. But the good thing is, good thing is we hedged the shit out of our position, which meant that the market didn't move up, down, left, right, whatever. So like I said, I am glad that when we spoke to the Patreon, we said, look, this is a great company. It's still going to do really well, but the market can get ahead of itself. So let's hedge
what's so funny is that we were kicking ourselves in the ass when the thing ran up to like 20 and just like, we got so cocky. We're just like,
let me tell you what happened.
We're gonna let that run. Let that run.
I was supposed to freaking like downshift a little bit in July. Remember that? I was like, man, you know like what?
20. It was 20.
I was like, I am gonna downshift some of my position. I'm gonna reduce my exposure. I'm gonna wait for a pullback so I could buy more, and this way I'll just chill because we all knew it was a little bit overbought at the time. Then this fucking Japan carry trade blew up in my face because I got greedy and I stayed in because of the whole Norwegian earnings. I was like, Norwegian earnings is coming up. You know, this is gonna be great. Blah blah blah. So I was like, all right.
I got so cocky when that thing happened. I was like, oh, I'm good right now. I'm good. Yeah. I definitely was not good.
But the good thing is I was smart enough to know that, hey, this shit got oversold. And so I added to my position with what limited dollars I had. And now I'm doing really well on it, you know.
I'm not gonna lie, the thing is bull flagging like a mofo right now.
I know.
Dude,
even after everything that's going on right now, it's consolidating at that 18 level. I think next year it gets back into the 20s. It sticks in the 20s, 25 range, 20, probably 2026. You might see it break out, you know, above the 25s into like the 30s a little bit. So great company, doing great things, going to benefit significantly from rate cuts. The only thing is this giant move in rates back and forth. Are we going to end up with a terminal of 2 or are we going to end up with a terminal of 3? That's the only thing that's probably like making its like volatility like gyrate as much as it has been, you know?
Yeah. So for the most part, I actually went long TLT. I bought leaps on it because this time I kind of
why, man. Why?
Well, I mean, you know, I think it's probably got very limited downside from here. And on top of that, I didn't want to buy US equities today, but I had some cash, so I wanted to allocate it somewhere. So I ended up buying leaps on TLT. This is actually the 10-year chart, so it's going to be inverse TLT. But what I do think is that rates are going to continue
I'm going to
trending down.
disagree. I'm going to
for
disagree
it.
with you on TLT, and I'll tell you why
That's
I'm going
cool.
to
That's
disagree.
cool.
I'm going to tell you what. I'm going to tell you why I disagree with the TLT move.
Tell me.
With all the shit that's happening with this, what is this thing called? You've got two major risks on the horizon. One risk is oil shoots up. If Israel tries to target Iran's oil infrastructure, they're going to knock out about 3 million barrels of oil. And not to mention the Strait of Hormuz is going to turn into it's going to get turned into a fucking like war zone, right? So the chances of oil having that risk is high. So that's one. So if oil prices go up, inflation is naturally going to go up and all this other shit. Now you've got also this port strike bullshit happening at the same time. So now if that stays for a prolonged period of time, you've got another thing that might cause inflation, in which case now you've got another problem. The other thing is the unemployment numbers that came out today were actually good. There's a lot of openings in the freaking economy, which means the Fed is not exactly going to be the, you know, what is that thing called? Like it's not going to want to cut as deeply in as short term as possible, which means that now you've got a terminal rate for the 10-year that's going to be probably closer to 4, maybe 4.5, like historically, rather than what it is around 3 and something right now. So I think a lot of people, they're looking at the long yield and saying to themselves, hey, wait a second, why the hell am I accepting a 3.75% total yield when long term the Fed is saying we're going to get a 3% on the federal funds rate, which means that the 10-year should be trading at 4, you know? So just like I said, just keep that in mind that unless TLT would be really good if we had an indication that a recession was upon us, like imminent recession is upon us.
TLT is a risk-off safe haven, right? So if this escalation continues, or if we tend to head in the direction, like did you see how much? Did you see how much the market priced in 50 basis points in November? Like it went up like 20. It went up like 20% by that probability. As long as that probability does go up, and as long as we get closer to rate cuts, because right now it's 25-25 at least. It's 50 by the end of the year, right? So it's either 25-25 or we're going to go up from here. The way that I see it is that the more rate cuts are priced into the market. Well, I think it's good hedge, dude. I mean, like with all the things with all the uncertainty that's happening right now, like we're going to bid up TLT.
Why not just stick to like the 1 or 2 year treasury? Why the 10-year?
Because the IEF doesn't, it barely moves. Because of the way.
But if you're looking for security, then that's the one you want to be with. I mean, look,
I'm TLT was not security.
TLT, remember, I think TLT was a great time to buy when rates were at like 5. You know, the yield
did do that
5. You know, but right now you're kind of buying something that's a little bit overbought, man. So there's other places to keep your money that are a lot less risk, like China. Just double down on China.
I'm not going to double down on China. I have a huge bet on there. I'm not going to go balls to the wall deep, dude. Like I have a good amount of my capital in there, my portfolio in there, and they're in leverage. They're in options. Okay. Like this isn't like shares where I can put a little bit extra if I want to. But I don't think that we're going to see material downside in the stock market. So I did not want to liquidate certain companies or certain options or trades that I have, because I do think that we're in a melt-up mode still. I think this is just fear that's happening in the market right now.
The one thing I'd say be careful with is deglobalization is going to be inflationary. You're definitely going to have like counterpoints that are going to be disinflationary, but let's just keep that in mind. So I would say I would not be long on duration right now. I just stick to, you know, what's working.
Okay, yeah. Deglobalization. Okay, we're talking about bearish the US dollar, right? Because if people buy international equities, the dollar will go down.
I'm talking about goods. I'm talking more on goods and services.
Okay, so what I'm trying to explain to you is, I know you're talking goods and services, but with what's happening in China, right? People are going to sell US dollars to buy Chinese equities, or in that sense. So the US dollar is going to go down. And plus, we're already in a rate cut cycle, so the US dollar is going to trend down. And once we break that 100, did we break that 100 level today? The DXY? No, actually we rallied a little bit today. So if the US dollar breaks down, dude, that's actually good for rates, because rates do go down, or bonds do get bid up when the US dollar goes down, because those are negatively correlated. That's why whatever I bought today is non-correlated assets. It is not dependent on US equities. Bonds can go up even when equities go up, and they can go down when equities go down. Also, on top of that, China is obviously can go up when the U.S. goes down. Like it very clearly can happen. And
did you buy calls on TLT, or did you just buy just TLT itself?
How about leaps on TLT?
Interesting. Yeah, definitely not the play that I would make, dude. But it's okay.
How it plays out, man. We'll see how it plays out. Look, let me tell you something. If in like a few months it doesn't go anywhere, then that's cool with that. I'll pay a little bit of I paid a little bit of tuition fee for that theta. That's fine with me, because I do not want to put the money. I don't want to put that much money in US
China, right, baby. China. That's what you want to be, man.
Honestly,
China.
I'm not gonna get fucking greedy. I already have a good amount in there. Like I could put it in China, but
this is the time. Be greedy when others are fearful.
I was greedy. I was, and I'm capitalizing.
We're at the hour mark. We're at the hour mark. So let's head out.
All right. But before we go, just as a reminder, everyone, thank you again for watching. If you haven't, we do these probably every couple of days. We took a little bit of a hiatus, but we're back now. We're back. We're bigger and better now. So make sure you like the video and make sure you subscribe in case you have to subscribe and turn on notification bell, because today we just like, you know what? Screw it. Let's just go live today. So we went ahead and did it, and we're going to keep doing that from now on. But we'll probably have more solid schedule as time continues. We're renaming
the podcast. We're renaming it to the Long China Podcast.
China Podcast. And then that is when the top is in. That is when the top is in. Then we'll have to rename it back.
All right. Later, guys.
All right, guys. Thank you.
Take care.